In this video, I will be explaining the accounting concepts of debits and credits. Before starting this video, please be sure to like this video if you found this helpful, comment with any video suggestions or questions, and subscribe for more content. Debits and credits are identified in double-entry bookkeeping. The general principle of double-entry bookkeeping is that any transaction that is accounted for will always have two sides, a bit like a coin, which always has two sides of heads and tails. These transactions are recorded using T accounts, either manually written in ledger books or in computerized accounting systems. The name of the T account comes from the letter T displayed above the split of debits and credits. Each entry is recorded with the date, description, and amount. The best way to distinguish a debit from a credit is to identify what type of transactions are increased when input in either side as stated above. Following the principles of double-entry bookkeeping, there are general rules to apply to each type of transaction, i.e. the effects on debits and credits. A transaction will always have an opposing effect, where one side of the transaction shows an increase and the other side shows a decrease. This is stated above and will be shown in scenarios later. Here is an acronym which will help you remember what type of transactions increase by debit or credit. Debit will always be on the left side and credit will always be on the right side of a T account. Remember, the rules for either debit or credit are for the increase in value. Therefore, with the double entry process, we can interpret, for example, that if expenses are increased by debiting, then they are decreased by crediting. The same concept will apply to all other transaction types as stated in the previous slide. Now we will look at a worked example to apply the concept of debits and credits. We can see there are a few transactions that have occurred in the month of January. Have a think about these events and consider which type of accounts are affected, in addition to whether the effect is that of a debit or a credit input. A tip for this example is that the main account being affected is the bank account, where money is either coming in by debit or going out by credit. The central activity is from the bank account, as this is where all the money is either being received or being paid out from. Hence, we can draw up a bank T account with all the relevant transactions occurring. For the bank or cash account, receipts are debited and payments are credited. Using the acronym from earlier of DED-CLICK, we can interpret that scenario A is for capital, which to increase is credited. Scenario B is for an expense, which to increase is debited. Scenario C is for an asset purchase, which to increase is debited. Scenario D is for income, which to increase is credited. Scenario E is for drawings, which to increase is debited. And finally, scenario F is for loans, categorized as liabilities, which to increase is credited. Here are a few summary points on this video to remind you of what has been covered. Remember, double-entry bookkeeping will always have two sides to a transaction, which is where debits and credits come into play. To remember the general rules in recording a debit or credit, learn the acronym of DED-CLICK. This will help you know which side to show an increase in a particular type of transaction. Last but not least, remember to use the T account format shown in this video to illustrate your answer when asked to show the effect of different transactions in standard double-entry bookkeeping. Okay, well, I hope you found this video helpful. Please like if you did, and subscribe and turn on the bell icon to be notified when I upload. Thank you for watching.